Hey, what's up guys, you're back with another video. Welcome back to episode 6 of how to get started trading crypto. So far you have learned how to read charts, use indicator and even place your trades. But none of that matters if you don't understand the single most important part of the trading, that is risk management. In this episode we are going to be covering complete in depth of how you can use risk management to get more edge on this market. Most traders don't lose because they pick the wrong coin or pair or use the wrong indicator. They lose because they risk too much. One bad trade wipes out their entire account and the cycle of revenge trading begins. So in this episode we will learn risk management. And also, before getting started, if you still haven't checked out Deeptradex, make sure to check out. The link will be provided in the description. Currently they are giving away early birds benefit that you can take part in and get some bonuses. And let's get started with the video. Today I'm going to show you how professional traders protect their capital, control their losses and stay in the game long enough to become profitable. Let's start with the basic. Risk management is simply the process of controlling how much you can lose on any single trade. Your number one goal as a trader is survival, because if you can stay in the game, you will learn, you will adopt and you will grow. So these are the golden rules of risk management. That is, the first is professional approach. Risk only 1 to 2% of your account on single trade. This allows you to survive over 50 to 100 losing trade without significant damage. Second is beginner mistake, that is 10 to 50%. Risking 10 to 50% means just 2 to 10 losing trade, you can destroy your entire account. Recovery becomes nearly impossible. That brings us to the most important rule in risk management, that is never risk more than 1 to 2% of your account on a single trade. Let me explain why. If you risk 10, 20 or even 50% of your account on a trade, it only takes one bad move to destroy everything. For example, if you risk 50% of your account, you need 100% gain just to become break even. That's almost impossible for a beginner. Here is account recovery reality. Loss percentage 50, required gain to break even is 100%. Loss percentage, if it is 20% loss, then required gain to break even is 25%. Now let's talk about how to calculate your position size, because this is where most beginners go wrong. Position sizing tells you exactly how much to buy or sell so that risk stays within safe limits. Here is a simple formula, that is position size is equal to account balance into risk percentage divided by total stop loss distance. Let me give you a quick example. Let's say you have $1,000 account and you are risking 1%, that is $10 per trade. If your stop loss is 2% away from your entry, you divide $10 by 2%, that gives you a $500 position size. That means you are only risking $10 even though your position is $500. That is smart trading. Now let's talk about the stop losses, your safety net in the market. A stop loss protects you from unexpected price drop and from your own emotions. There are two types of stop losses, the hard and the mental one. The first is a hard stop loss, that is, it is automated. You place directly on the exchange. It is reliable, that is execute even when you are not watching. Emotional free, removes human error and hesitation. And also it is recommended for beginner as well as professional. Always use a hard stop loss. And the second is mental stop loss, manual, that is you promise to execute manually, means you will watch out for your stop loss level and you will manually exit once price reaches at that point. And it is also unreliable because emotional often prevent execution, means sometime you emotionally cannot exit out of a trade, means if you don't exit at your mental stop loss level, then you might be risking much more, because there can be a sudden price drop and you will be losing your entire account. And it is not recommended for any serious trader. Never rely on mental stop losses. And now let's talk about the risk to reward ratio, also known as RR. This This is how much you are willing to risk compared to how much you aim to make. A good trader always aim for at least 1 to 2 or 1 to 3 ratio. This means risking $10 to make 20 or 30. With a good risk to reward ratio, you don't need to win every trade. Even if you win only 4 out of 10 trades, you can still be profitable. That is the power of risk management. Now for mistakes. Mistake number 1, that is trading without stop loss. No safety means unlimited downside risk. Always use a hard or a mental stop loss. And second risk is using too much leverage. Leverage amplifies both gain and losses. As a beginner, avoid leverage or use a minimal amount of 2 to 5x. Trading too big. Position size should be calculated based on what we have already discussed, that is based on risk percentage, not account balance. Don't let greed override discipline. And the fourth mistake is revenge trading. After a loss, emotion leads to impulsive trades to win back money. This almost always leads to bigger losses. Fifth is adding to losing position. Averaging down on a losing trade compounds losses. Cut losses quickly and move on to the next opportunity. There are hundreds and hundreds of opportunity out there. If it is not on this pair, try another pair, but there will be always a next opportunity. Ignoring market condition. Risk management should be adapted to volatility. Reduce position size during highly volatile period. For example, if you think that there is a potential opportunity but the market is really volatile, or there might be a news, so instead of taking a regular position of 1% size, try out a smaller position size, because if it goes wrong, then you will be only losing half of the percent that you are normally risking. So this is a common risk management that you should take care of. These mistakes destroy more accounts. This mistakes destroys more account than bad strategy ever will. Risk management also plays an important role in trading psychology. When you already know exactly how much you can lose, emotions disappear. You stop panicking, you stop hesitating, and you stay objective even during volatility. And this is how professional thinks. That is benefits of risk management. Now let me give you a quick practical example. Imagine Bitcoin is sitting at a strong support level. You decide you want to enter or trade with a stop loss just below support. Your account is $1,000 and you decide to risk 1%, that is $10. Your stop loss is 2% away. Using the formula, your position size become $500. Whether the trade wins or loses, you are always in control. That's what matters. Risk management is not about avoiding losses. Every trader loses. Risk management is about controlling losses so they never hurt you. That's a wrap up for episode 6, risk management and position sizing. This is the episode that separate gamblers from real traders. Follow these rules and you will protect your capital, your mindset, and you can become a profitable trader in a longer term. In episode 7, we are going to step into more advanced part of trading, that is futures and leverage. But don't worry, we will break it down so simply and I will show you how to avoid the danger. Make sure to subscribe and turn on those bell notification so you never miss out an important episode in the series. That's all for this video, guys. If you enjoyed this episode, then make sure to hit the like button and subscribe. Thanks for watching and see you guys in the next video.